The United States Treasury plays a crucial role in global finance, with U.S. Treasury securities serving as a preferred investment for many nations due to their stability and liquidity. Historically, these investments have supported the U.S. dollar's dominance as the world's primary reserve currency. However, recent policy decisions under President Donald Trump's administration have introduced significant uncertainty into international markets, prompting some countries to reassess their reliance on U.S. financial instruments. In early February 2025, the president escalated Trump's previous trade policies on steel and aluminum imports. These tariffs include a 15% duty on imported steel and a 10% duty on aluminum, a move intended to boost American production, but one that has sparked concerns over rising costs and potential retaliation from trading partners. Furthermore, the administration has signaled plans to impose blanket tariffs on all imported goods from every country, a dramatic escalation of Trump's previous trade policies. This proposed measure, aimed at reducing the U.S. trade deficit, could further strain global trade relations and disrupt supply chains. Such aggressive tariff policies may deter international investment in the U.S. as countries seek alternative markets and diversify their foreign currency reserves. The latest data from the U.S. Treasury reveals a notable decline in U.S. Treasury holdings by several countries over the past decade. China's holdings of U.S. Treasuries have declined significantly. By March 2024, this figure had decreased to approximately $767.4 billion. Several factors contribute to this reduction. Historically, China's significant trade surplus with the United States led to an accumulation of U.S. dollars. To manage the exchange rate of the renminbi, RMB, and maintain export competitiveness, China invested these dollars in U.S. Treasuries. However, since 2018, as the trade imbalance has declined, the need to buy U.S. Treasuries to manage the RMB exchange rate has naturally diminished. Chinese policymakers are facing increasing calls to reduce the Chinese financial system's exposure to dollar assets. This strategy aims to mitigate risks associated with over-reliance on a single asset class and enhance returns by exploring alternative investments. The evolving geopolitical landscape, particularly tensions between the US and China, has prompted Beijing to reassess its holdings. Reducing exposure to U.S. debt is seen as a measure to minimize potential vulnerabilities arising from political frictions. A sizable sell-off of Treasury securities by China would almost certainly lead to an appreciation of China's currency and a depreciation of the dollar. Contrary to the claims of many observers, this is more likely to help the United States than harm it. It is important to note that while China's absolute holdings of U.S. Treasuries have decreased, the overall market for U.S. debt has expanded. As a result, China's share of total outstanding U.S. Treasuries has diminished over time. In 2011, China owned about 14% of all outstanding Treasuries. But by 2024, this share had fallen to less than 3%, the smallest in 22 years. Japan's holdings have also decreased. Over the last few months, Japan remains the largest foreign holder of U.S. Treasuries, a position it has held for several years. The slight reduction in holdings is primarily attributed to Japan's ongoing interventions to stabilize the yen, with the Japanese yen experiencing significant depreciation against the US dollar. The Bank of Japan has periodically sold U.S. Treasuries to prop up its currency. Furthermore, Japan's own fiscal policies, including yield curve control and inflationary measures, influence its reserve management strategies. India's holdings of U.S. Treasuries fell from $200 billion reflecting a 3.07% decrease. India's reduction in US Treasury holdings aligns with the Reserve Bank of India's foreign exchange management strategies. The RBI has actively intervened in currency markets to stabilize the Indian rupee, which has faced depreciation pressures due to global economic volatility, rising US interest rates, and capital outflows. Additionally, India has been diversifying its foreign exchange reserves by increasing its gold holdings and exploring alternative asset allocations. This move is also part of India's broader strategy to reduce dependence on US dollar-denominated assets while strengthening trade partnerships with emerging economies. Saudi Arabia's holdings of US Treasuries have also declined, focusing on economic diversification through its Vision 2030 strategy. As a major oil exporting nation, Saudi Arabia's US Treasury holdings fell by $3.56 billion, a decrease of 2.59%. Saudi Arabia's foreign exchange reserves and US Treasury holdings are closely tied to global oil price fluctuations. The recent decline in holdings likely reflects a combination of lower oil revenues and strategic financial planning by the Saudi Arabian Monetary Authority. The kingdom has been focusing on economic diversification through its Vision 2030 initiative, which aims to reduce reliance on oil revenues and invest in domestic infrastructure, technology, and green energy projects. Additionally, Saudi Arabia has strengthened its financial ties with China and other trading partners, which may influence its allocation of reserves away from US Treasuries. Germany's holdings of US Treasury bonds have also decreased. Germany, the largest economy in the Eurozone, holds US Treasuries as part of its foreign exchange reserves, primarily managed by the Bundesbank. The slight reduction in holdings, amounting to a 2.4% drop, could be attributed to shifts in Germany's reserve management strategy amid inflationary concerns and changing monetary policies within the European Central Bank. Additionally, Germany has been increasingly investing in green bonds and diversifying its sovereign reserve portfolio to align with long-term economic sustainability goals. The reduction may also reflect ongoing efforts to strengthen the euro's role as an alternative reserve currency in global markets. Norway's holdings of US Treasuries have also declined, decreasing by $159 billion, translating to a 1.73% drop. Norway's US Treasury holdings are largely managed through its sovereign wealth fund, the Government Pension Fund Global, one of the world's largest sovereign wealth funds. The fund follows a diversified investment strategy, allocating significant capital into equities, fixed income securities, and alternative assets. The slight reduction in US Treasury holdings reflects reallocation efforts toward higher yielding investments in response to changing global interest rate environments. Additionally, Norway's economic policies focus on balancing risk while maintaining long-term financial stability, contributing to periodic adjustments in its Treasury holdings. The decline in US Treasury holdings by these major foreign investors highlights the evolving landscape of international financial markets. Many nations are shifting towards alternative assets, including gold, digital currencies, and green investments. In response to changing economic conditions, countries with volatile currencies are actively managing their foreign exchange reserves to stabilize their economies while mitigating risks associated with global inflation and interest rate fluctuations. Despite these reductions, US Treasuries continue to play a critical role in global finance, offering liquidity, security, and a store of value. However, the shifting dynamics underscore evolving international economic policies and reserve management strategies. Additionally, foreign official institutions, including central banks and sovereign wealth funds, reduced their U.S. Treasury holdings from $3,851.1 billion in October to $3,956.3 billion in November. Treasury bond and note holdings declined slightly from $3,539.5 billion to $3,151.9 billion, while Treasury bill holdings by foreign official entities fell from $31.8 billion to $34.4 billion. A shift toward alternative financial assets instead of U.S. Treasury bonds could lead to higher borrowing costs for many nations, prompting them to reassess their reliance on the U.S. dollar. Countries that traditionally held large reserves of U.S. Treasury bonds are now diversifying into alternative assets, particularly gold. Over the past year, global central banks have increased their gold purchases as a hedge against dollar volatility and trade instability. This shift poses a potential threat to the U.S. financial system, as decreased demand for U.S. Treasury bonds could lead to higher borrowing costs for the U.S. government and a weakening of the dollar's global standing. The Triffin dilemma remains relevant, as America's need to run trade deficits to supply the world with dollars conflicts with long-term confidence in the currency. If foreign investors reduce their holdings of U.S. debt in favor of gold or other stable assets, it could undermine the dollar's reserve currency status. You've enjoyed the video so far. Could we ask a small favor? Hitting the like button helps us reach a broader audience, and sharing your thoughts or feedback in the comments makes an even bigger impact. Thank you for watching. Now let's dive back in the pre-Bretton Woods era. Before 1940, the British pound served as the primary reserve currency for much of the world. However, its prominence was deeply intertwined with the vast expanse of the British Empire, whose extensive trade networks and financial infrastructure facilitated the pound's widespread acceptance in international commerce. By the late 19th and early 20th centuries, the British pound was the dominant reserve currency. However, the financial strains of World War I significantly weakened Britain's economic standing. The war effort led to substantial national debt and the depletion of gold reserves, undermining confidence in the pound. Attempts to restore the pre-war gold standard in 1925 were short-lived, as the Great Depression further destabilized the global economy. By 1931, speculative attacks on the pound forced Britain to abandon the gold standard entirely, leading to further instability in global monetary arrangements. Meanwhile, the United States was emerging as a formidable economic power. The establishment of the Federal Reserve System in 1913 provided the U.S. with a centralized banking authority, bolstering financial stability. During the interwar period, New York rose as a significant financial center, rivaling London, and the U.S. dollar began gaining traction as an international currency. The aftermath of World War II further shifted the balance. The Bretton Woods Conference in 1944 established the U.S. dollar as the world's primary reserve currency, backed by the world's largest gold reserves. This agreement solidified the dollar's central role in global finance, as countries pegged their currencies to the dollar, which was convertible to gold. The Bretton Woods system, 1944 to 1971, was a fixed exchange rate system designed to promote economic stability and prevent the competitive devaluations and protectionist policies that had contributed to global economic turmoil in the interwar period. A cornerstone of the Bretton Woods Agreement was the fixed exchange rate system, where the US dollar was pegged to gold at a fixed rate of $35 per ounce, and other major currencies were pegged to the dollar, making it the anchor of the global financial system. To support and oversee this new economic order, the conference led to the creation of two key institutions. The International Monetary Fund, IMF, was established to maintain a system of fixed exchange rates centered on the US dollar and gold, providing a forum for consultation and cooperation on international monetary issues. The International Bank for Reconstruction and Development, now part of the World Bank Group, was created to provide financial and technical assistance for the reconstruction of war-torn Europe and the development of other economies. This arrangement solidified the dollar's status as the leading global reserve currency, as the US economy emerged from World War II as the strongest and least damaged among major powers. Global confidence in the dollar grew throughout the 1950s and 1960s, with central banks worldwide holding large reserves of US dollars, reinforcing its dominance. By the late 1960s, rising US debt and economic pressures strained the Bretton Woods system. In 1971, President Richard Nixon took the unprecedented step of suspending the dollar's convertibility into gold, an event known as the Nixon shock, which effectively ended the gold standard and led to a system of floating exchange rates. Although the US dollar was no longer backed by gold, it remained the dominant reserve currency due to the relative strength of the US economy, the stability of US financial markets, and the widespread use of the dollar in global trade and oil transactions, often referred to as the petrodollar system. Despite some volatility in the 1970s, the US dollar remained central to international trade and finance. Following the collapse of the Soviet Union in 1991, the 1990s saw globalization accelerate, with the US leading in technological advancements, financial innovation, and capital markets. Key developments during this period included the dominance of US Treasury bonds as the safest asset for global investors and the expansion of the US financial system